Good afternoon, ladies and gentlemen. Welcome to today's webcast titled Cost Report Preparation, 4 Ways to Improve Accuracy. If you would like to submit a question to our presenter during this webinar, we encourage you to use the questions/chat feature in your webinar browser. Our presenter will address submitted questions and comments at the end of today's webinar. At this time, it is my pleasure to introduce Jeff Wolf, Director of Reimbursement Services at BESLER. Jeff, the floor is all yours.
Thank you very much. Good afternoon or morning to everybody who's in attendance. We're going to talk about some ways to improve the accuracy of our cost report today. A couple of things that we're going to talk about before we get into the 4 specific issues is a couple of basic reimbursement principles, the matching principle and some basic reimbursement issues that we see quite a bit out in the industry. The first one is the matching principle. It's a simple concept, but with the complexity of healthcare, it can get lost. The basic principle states that revenue should match our expenses that created those particular revenues. So things like when we're doing a revenue offset, we should be matching the revenue against that expense. And that seems pretty elementary, but there's times when healthcare makes that difficult. And what kind of issues are these? Well, we have things like the cafeteria. Most hospitals don't have a cafeteria department. They create it via a reclass. So our revenue is offset usually against the department that created it, which is dietary, but we have to shift that up to the cafeteria. So we need to pay attention to some of those areas. So how do we avoid those issues? How do we figure out where those issues exist? Usually they're surrounded by A6 reclasses or A8 adjustments. When we see A6 reclasses that have a revenue impact or a revenue associated with it, we want to take a look at those and make sure that we've identified them. Basic reimbursement principles. When you find during an audit, there's really 2 kinds of adjustments that happen that the Medicare and Medicaid auditors make. And the first one is they're treating an expense or revenue differently than was expected by the preparer. And usually that's a disagreement over the regulations or the interpretation and the like. And those tend to be ones that we have to deal with quite often, but they're items that can be resolved, researching the regs, things like that. The other one is mistakes that are made during preparation. And those are the ones that actually become more problematic for us because once the auditors start seeing mistakes made, they start having an interpretation that you've made one mistake, you've made more mistakes. So avoiding those mistakes and avoiding the inability to document properly what we're doing is going to become real important. And so that's why we want to talk about the accuracy of our cost reports. We also want to talk a little bit about in doing the work papers and the supporting documentation, that accuracy is critically important because again, the Medicare auditors and the Medicaid auditors, when they start finding mistakes, they start making assumptions. They can do spreading out of the error, extrapolating that over population, things like that. So you want to make sure that the documentation you have is as accurate as possible. One of the things that's important to do is to make sure the documentation shows step by step the progression from the raw data, whether it's the general ledger, whether it's the payroll file, whether it's a revenue and usage file, or whether it's a download of the AP for certain sub-account in the general ledger. Show all of the data and then show the progression down to what you need. Where that becomes problematic is we see work papers all the time where it starts off saying worksheet A salaries, $300 million, nursing overtime, $175,000. And you don't see the progression that gets you there. So it's hard to see how 175 out of $300 million is the right number. But if you showed the progression, $300 million is total salaries. Nursing salaries is $86 million. All of the incrementals for nursing is, let's say $3 million, and the overtime is only $175,000 out of that. And the auditors can see the progression and see the filters that were applied to make sure that they understand how you got to that number. Again, we don't want them to be working on mistakes. We'd much rather have you and the auditors working on issues where they disagree with treatment because the documentation will show what you did. So with all of that in mind, we're going to go ahead and talk about the 4 areas that we want to improve accuracy in our cost reports. The first one we're going to talk about is wage index hours analysis. And then we're going to talk about how the impact of A6's work with wage index. And I realize that we're going to talk about wage index on 2 of these bullet points, but that's because wage index has a significant impact on our reimbursement. So there's 2 issues there that we definitely want to cover. The third item is going to be talking about revenue matching with the expenses and making sure that our revenues are reflecting any of those changes from A6s and A8s, and we'll walk through how that's done. And then the last thing is we're going to talk about understanding how patient care is provided at your facilities versus how CMS pays for services. And this is becoming a bigger and bigger item. And as we talk about this, you'll see how this starts to impact our cost report and the things we need to look for. So when we're looking at the wage index, one of the most important things to look at is what is an includable hour versus an excludable hour. Our wage index comes from our payroll system. We're looking at what the average hourly pay rate is for various types of employees, various departments, things like that. And one of the things that we have to look at is our payroll files have a column that's called hours. But it's not always true hours. There's usually more than the actual number of hours worked. What we're looking for in includable hours is the actual time worked by the staff for the compensation they were paid. You're not looking for what payroll systems use the hours for, which can be duplication of effort. An example of that would be a nurse working 1 hour on a Saturday. The nurse's regular pay is $40 an hour. So a lot of times you'll see in a payroll system, $40 an hour, 1 entry with a regular earnings code. You're then going to say, oh, that person is also working the weekend. So that weekend is going to get a differential. And that maybe the weekend pay is 25% of normal. So they're going to get another 1 hour at $10 an hour. And then maybe it's nighttime on the weekend and they'll get a third differential that's nighttime differential. And maybe that's $5 an hour extra. So realistically, that nurse made $55 an hour, even though their base salary is $40. They made $55 an hour, but in the payroll system, you'll actually see 3 hours because the system is tracking how many times they paid for each of those different earnings codes. And every payroll system's a little different, and the one that I'll show later on in here, you'll see that some hours are counted and some are not, even though they're not all includable hours. So you really have to take a look at your payroll system and make sure you're identifying the includable versus the excludable hours. What kind of tests can you run to make sure that you have identified the includable hours correctly? Well, one of the easiest tests to run is an average hourly rate comparison. Take your payroll file, subtotal it by earnings code, and do a calculation of the dollars versus the hours for each earnings code. And what you'll see, and I'll have a work paper that I can show you in a minute, what you'll see is that the earnings codes will start to stratify by the actual worked versus the differentials versus things like bonuses that don't have any hours. How do you document this? Because the auditors are going to want to see support behind what you claim as includable hours. Again, I would recommend you start with the total. Document total hours in the payroll. Document what you've excluded as well as what you've included and show that that reconciles to the total. And then you can move forward with the included hours. One of the things that we have seen quite a bit, especially with wage index, because the data is large, is we're using reports that are pulled by our IT department. Some organizations call them cubes, other people call them queries, whatever. But that person in the IT department is making a decision on grouping, because a lot of these reports we see come back with cost report line assignments already on them. And one of the things you want to make sure is that you, the reimbursement people, are the ones that are making the grouping decisions, because you may have changed the grouping since the last time the IT person updated their table, and consequently you may have variances. We've seen many organizations where they hand us a report that says, here's my payroll, and they'll have handwritten notes. Oh, this department changed grouping and this department changed grouping. And that's an indicator of those kinds of things. So one of the recommendations I will make to you to make sure that your wage index is correct, and this is true for any of your data, is get the raw data and do the groupings yourselves. You can do the VLOOKUPs in Excel or in Access, and you can make sure that the departments are grouped properly, because they do change periodically in reimbursement, and we want to make sure that that's done correctly. So one of the things that I'm going to do is we use at BESLER a program called Easy Work Papers, and it helps us prepare cost reports and document the supporting work papers. But I'll also show you how the same information can be done with Excel. So in this case, I am currently looking at a demo hospital for you, and we're going to take a look at how to document and how to identify our wage index. So one of the things I said at the outset is make sure to identify the total hours for the payroll, identify the excluded hours and the included hours. You notice I also have a column for unknown hours. There will be new earnings codes periodically that your payroll system will start utilizing. You want to know when there's new earnings codes, and you need to identify whether they should be included or excluded. And you can see all the way down on my list that if I go to the bottom, my grand totals will reconcile. And so you can see what the kinds of hours that you're dealing with. You can show that that reconciles back to the payroll, and that this 11 million is what we're going to use going forward. Remember, I said you want to document what your excluded earning codes are. So you want to have printable reports that you can provide to the auditors that show what the earnings codes are. So you can see here, wellness reward, shift differentials, all of these kinds of overtime pay. Remember, those are the kinds of things I was talking about. They're incremental pay on top of the regular salary that the employees make. And you want to have documentation of how you determined and which codes you included and excluded. So this would be a list of excluded codes. I talked about earlier using an Excel file to identify what you have for, the average hourly rate. And here's every earning code that was in the file that I pulled. And you can see, some of these people are making $29, $40 an hour. Those look like normal hours. But then you have things like, this adjustment. That's not going to be an hour, that's an administrative thing. Or you're going to have things like bonuses. So you see this bonus where an additional amount was paid, but there's no hours associated with it. And so you can see that in this particular payroll system, they did not track how many times they paid a bonus, but they did track bilingual pay. And you can see on this bilingual pay that we're looking at 50 cents of a bump on their regular pay because they're bilingual. So those are the kinds of things. This 12,000 hours would need to be considered an excluded hourly rate or excluded hour in order to get the correct number of hours that employees actually worked, so that you get a fair and accurate average hourly rate. Okay. All right, so our next issue is we're going to talk about A6s and how A6s impact your wage index. One of the most important things that we do with the cost report is we are adjusting the cost report from our financial accounting to Medicare. And why do we do that? Medicare has certain rules and regulations about how they're going to pay for things or how they want to see certain expenses. Depreciation is an example. Many financial auditors put depreciation in the department. Medicare wants to see it up in a capital line, and they want to see it allocated down based on a statistic. In operations, we have labor delivery, postpartum nursery commingled because those staff function for all three services. Medicare, unfortunately, pays for them separately in different categories, so we have to split them apart. So we do these A6 reclasses to move the expenses from one cost report line to another. Where it impacts our wage index is when you have a salary component to that reclass. So when we talk about reclasses, you'll see that there's salaries and non-salary components. And the salary component is what is going to impact the wage index. Because if we move the dollars, we have to do what we call follow the leader with the hours. We have to make sure that those hours are doing the same reclass so that we are matching up, remember our matching principle, our hours with the expenses that incurred them. So what type of reclasses do we have salary components for? You'll find departmental reclasses. Those will be examples like labor delivery, dietary, cafeteria, organ acquisition, transplant, and we'll show a couple of examples of that. Other reclasses that we have are employee type reclasses. So we can talk about social workers or nurse practitioners. We move them from wherever they are booked to where Medicare wants to see them. We can also have individual employee reclasses. There are times when employees are paid and booked out of one department, but they're actually functioning in multiple departments. A lot of times that's a director or something like that, where they have multiple departments that they provide service for. And so in those cases, you're going to be identifying the individual, and don't forget to do their hours and make sure that that gets transferred with it. In each case, like I said, we have to identify the hours and follow the leader. We need to make sure that we've identified the hours associated with those people. How do we do that? How do we document this? How do we identify the hours with this person? The best way is to make sure that when you're using the payroll file, all of the records for that person or for that department or for that type of employee are put together. You show the totals, it can reconcile back to your payroll file, and the hours are included in the file. You do the reclass for both at the same time instead of doing the reclass for the expenses on one page and then somewhere else you do the reclasses for the hours. What about A8 adjustments? A8 adjustments can have salary adjustments. So for most hospitals, nurse practitioners are not an allowable expense. They're treated like physicians, but they don't belong on A8 too. So we have to remove them off of worksheet A8. When we do that, we have reduced the salaries for that facility for those nurse practitioners. We need to go back and adjust the salaries for our wage index since we've removed these people off the cost report. There's a number of other examples where you can talk about A8 adjustments, but anytime you make a salary adjustment, you need to look back, does that impact wage index, make the A6 reclass to move it from salary to other so that the wage index is properly reflected. So I'll show you some examples of that. So if we talk about labor delivery, and in this particular facility, they have 3 departments. They have a nursery, they have an OB, and they have a L&D department, but the services are commingled. And what we find is that in this particular provider, we used the revenue. We identified the nursery revenue, the OB revenue, and the L&D revenue. We created our percent to total, and we did the salary reclass. Very simple, very straightforward. We just use the percent to total to reallocate these dollars to where they actually belong based on the volume of services provided. At the same time, further down our page, we took the hours that went right along with that, did the reallocation, and created the net reclass. So what I was talking about earlier, make sure that on one work paper you can document these salaries reconciled directly back to worksheet A, and then this is my increase side of my reclass. These hours will reconcile directly back to the includable salary, or excuse me, includable hours on your wage index, and there's your allocation and your net reclass. So when you look at an A6 reclass for salaries, you're still seeing just the salary itself reclass. But what you want to do is have a work paper, and it's something like this one here, this wage index impact of A6s, where you're actually tracking what your salary starting point was. So here's my worksheet A salaries, plus my labor delivery reclass, plus my social worker reclass. I have a bonus issue that was booked in other expense, and I have my nurse practitioners that I'm going to remove on A8. So all of those have a salary impact before I get to the net salaries that's going to go to my wage index. You'll notice here I took the starting hours. These are those includable hours. And again, I identified the hours that go along with the labor delivery. So you can see here's the increases. And as I page down, here's the decreases for those same hours. When we look at the social workers, there's the increase hours that goes with the dollars. There's one of the departments where the decreases are. There's another one. And there's a few more. So again, you can show that you are being consistent. You're applying the hours and the dollars in the same way. You're matching them up, and that the average hourly rate when you are done is a reasonable number for that type of employee. In the case of the bonus, you'll notice that there's no hours associated with bonus because that's not any extra worked hours. It's just an additional compensation. So you notice there's no dollars associated with it. But then we've got the nurse practitioners, which is an A8 adjustment. We're removing these dollars from the cost report, and here's the associated hours with the nurse practitioners. So our third topic is talking about matching our revenue and our adjustments to the A6 reclasses to our revenue. So one of the things that you want to pay attention to on the matching principle is our Worksheet C revenues should start based on the GL, because that way our revenues match our expenses. And it should be grouped by department so that they match. For the most part, that's pretty straightforward for most facilities. Once in a while, you'll find facilities that have a different department number for revenues versus expenses. Even though it's ICU 3010 department is the revenue and 6010 department is the expenses. You need to make sure that you match those up. You'll need to do a crosswalk to make sure that you're treating them the same and that they're working together. Because you want to make sure that you've matched your revenues and your expenses. And that's your starting point for Worksheet C. Once you've done your starting point for Worksheet C, you should take a look at all of the A6 reclasses and ask yourself, does this reclass have a patient treatment revenue impact? Does it actually have an issue that I have to also resolve on the revenue side? If you find one that you think, yes, it does, the second question that you need to ask is, how do I define that revenue? In some cases, it's straightforward. It's the revenue for that department. In other cases, it's not so straightforward. You have to look at the revenue codes. You have to look at the way it's being charged, and you may have to do some digging to find that revenue. But those are the two most important questions that you need to ask with every single A6 reclass. What types of reclasses can have impact on Worksheet C? We call them simple reclasses and allocations or complex reclasses. Both of them can have an impact. What is a simple reclass? A simple reclass is basically an expense that is being moved from wherever it's booked to one place on the cost report. Examples of that are utilities, depreciation, benefits. All three of those are simple reclasses, but none of those three, utilities, depreciation, and benefits, have a direct impact on patient treatment revenues. So those are examples of reclasses that, while they exist and they're important, they do not have an impact on our revenue. The second set of simple reclasses, medical supplies, implants, drugs, do have an impact on our revenues. If we are moving all of the expenses for medical supplies to Medicare Cost Report line 71, then we must do the same thing with the revenues in order to make sure we are matching revenues and expense. With medical supplies, this can be a little more difficult because depending on the hospital and depending on how accounting tracks those medical supplies, do they separately identify in the general ledger, do they separately identify the chargeable versus non-chargeable? Do you have to do some offline calculations to identify the chargeable versus non-chargeable supplies? Because we're moving the chargeable revenue, obviously, up, and we want those to match. Implants and drugs tend to be a lot easier. There's very little implants or drugs that we don't charge for in hospitals. So pretty much once you find the expense, you can move that, and you find the revenue based on the revenue code, you can move those. Then you have allocations or more complex reclasses. All three of these are examples. Cafeteria dietary is a more complex reclass. You are taking a whole department and you're allocating it based on the number of meals. Well, that doesn't have a direct impact on your revenue because that's not a revenue producing department for patient services. But if you look at your radiology admin department, that can have patient treatment revenue. So you need to look and see, does that reclass actually, the department that's being reclassed, does it have patient treatment revenue? And then how do I identify the revenue and how do I identify where does it go? And then lastly, labor delivery, postpartum recovery. Absolutely, that one has patient treatment revenue impact. Most providers, the revenue is in the one or two departments that they have that's commingled, and so we have to reallocate or reclass that revenue. In some cases, you will find that we have the expenses commingled, but the revenue is separately identified in different departments, in which case you may not have to do the reclass because it's already in your charge master correctly. So you need to look at these and make sure I've got an expense reclass. How do I identify the revenue? And then is it already moved or not? When we talk about A8 adjustments, they can have patient treatment revenue impact as well. Physicians, you're going to see those on worksheet A8-2 and worksheet A8. Obviously, Medicare doesn't want the patient treatment time for physicians on the cost report. We also don't want the physician treatment revenue on the cost report. So we need to pull those off. CRNAs, same thing. They're treated like physicians. NPs and PAs, again, same thing. We don't want those on the cost report, but be careful with NPs and PAs. There are some provider types, those people that have rural health clinics, that have exceptions to the NPs and PAs, and in fact, even to the physicians. So make sure you understand all of the components that you're looking at in your hospital. So we're looking at the expense, we're making sure the reclasses and the adjustments are done properly, but make sure that the revenues are appropriately moving with or without those expenses. And my last example would be 340B expenses. If you're offsetting them on the expense, you also have to offset them on the revenue. So again, let's go back to easy work papers and we'll talk about some of the same issues with looking at my worksheet C. So as I go into, I'll look at outpatient because it tends to have more issues. And so as you can see, I've got my general ledger revenue. That's my starting point. I currently have 4, 5 reclasses of revenue or adjustments to revenue. The first one I have is medical supplies. But if I go down looking at my A6 reclasses, I have a radiology admin reclass, which I don't see here in my Worksheet C. So my first question is, radiology is a patient treatment department. Why am I not seeing a revenue reclass? So I can take a look at my radiology admin reclass analysis. And one of the things that I added to this analysis is the first column here. You can see I identified the revenue from Worksheet C for each one of these departments. And the radiology admin department that we're going to be allocating down does not have any patient treatment revenue. So consequently, I'm able to say, I now know that there's no revenue associated with this particular reclass. Had the department have revenue, I would have need to go in and look at that revenue, probably look at the charge master, look at the rev codes, and identify which radiology department does that belong with and do the reclass. So if we go back to our Worksheet C, radiology admin, no Worksheet C impact. Building depreciation, there's no revenue impact for that. Equipment depreciation, equipment rent, interest, utilities. Those are all reclasses that we consider common reclasses. They usually don't have revenue impact. But once we get down to chargeable supplies, there's my revenue reclass for it. Implantable devices, there's my revenue reclass for it. How did I define those revenues? For drugs and supplies, they're pretty easy. They're a list of revenue codes for any single department. When I look at the implants, it's again specific revenue codes for any department. Drugs is the same way. So when we get down here, patient chargeable drugs. Laundry would not have an impact. Social worker, some hospitals charge for it, some don't. So you need to look, does your hospital charge for it? If you do, you need to follow the leader. You need to find out where are these people working. Your B1 stats are going to show them there, and you're going to need to have the revenue there. Dietary cafeteria. In this case, there's no salary. It's contracted service, but there's no patient treatment revenue in that department. But then you've got the labor delivery. And here's, oh, that's on my inpatient. Let me go to the inpatient for a second, because labor delivery is primarily an inpatient function. So when you are looking at these, you'll see inpatient versus outpatient can have different columns, because you're going to see in my inpatient, I also have the labor delivery, and that's where that reclass is identified. So you will have different columns because there may be different issues inpatient versus outpatient. Okay, so my labor delivery does have a reclass. It's identified on the inpatient side. And as I go down, bonus nurse practitioners. So nurse practitioners, I should be thinking about, do I have a revenue impact for that? Now, in this particular provider, all of the physician revenue was outpatient related, and it happened to all be down in these clinics. And when we dug into this particular provider's information, the nurse practitioners were billed under the same revenue codes as the physicians, which is very common. Same thing for CRNAs. They'll either be billed as anesthesia or they'll be billed under the physician. So one of the things we talked about, make sure you haven't already counted those before you do the reclass. So in this case, I've already got the physicians being removed. I don't have to also have a column for nurse practitioners because they're commingled in that revenue. Okay, so our last topic is going to be about understanding how your facility operates, how your facilities, your services are provided to the patients. And there are some matching issues when we talk about how we provide care versus how the system charges for things versus how CMS pays for them. Examples we've already talked about, medical supplies. We charge those out to every department that delivers the supplies to the patient. Same thing with the drugs. As they're administered to the patient, they're identified by the department, and we have a reclass, both of expense and of revenue, from where they were booked in our financials up to the Medicare cost report line. For supplies, it's 71, implants 72, and drugs is 73. And those are well known. But there are some that are more complex, like labor delivery, because we have to look at those revenues by the type of revenue. We have to look at the nursery revenue by revenue code and pull that out of those departments. Then we have to look at the labor and delivery, the 720 revenue codes, and pull that out of those departments and put it into the Medicare line. And then the leftover OB needs to be moved to the line 30. So you have to do a little more work when they're more complex reclasses. In the example of the radiology, even though we didn't have revenue, if we had revenue in that department, I would have looked at the revenue codes. How much of that revenue is regular radiology versus CT scan versus ultrasound or whatever, and moved that revenue appropriately to the department based on the revenue codes. So one of the things you'll hear me say about the revenue reclasses is using the revenue codes, and that's a very big test that I use is the revenue code. So that's probably my number one place to look for. How do I treat that revenue? Is it being identified easily, correctly? There are some services that are starting to pop up as new issues. Over the last 3 or 4 years, laboratory, they have what they call point of care tests. Those are those simple, prick your finger, put a little bit of blood on the thing, and it tells you the blood type, or it tells you the sugar level. And there's some other things that it will tell the nursing staff. And those are laboratory tests. We charge for those. However, it does not require anybody from laboratory or with lab experience to actually administer those. We have nurses and nurse aides administering those. And so consequently, identifying the expenses with those and the revenues with those and trying to match them up is becoming a little more complex. The same thing is true with EKG tests. If you think about an EKG test, and most of us have had them for one reason or another, the nurse or the nurse aide will stick the leads on your body, that's connected to the machine. They'll push the button on the machine and it runs the little tape. And at the end of the run, the tape is ripped off and given to the doc, and the doc reads the tape. There was never a respiratory therapist or an EKG tech involved in the procedure. So again, we're seeing EKG tests being performed by the staff in clinics and in emergency and in room and board and in other places where the respiratory therapy or the EKG staff aren't there. The EKG staff and the respiratory staff are doing much more complex procedures like stress tests and things like that, which there's plenty of revenue, and there's separate revenue codes than the basic EKG test. Another example, ultrasound. Now, normally we would think ultrasound requires a radiology type person or tech to run that. But anybody who's had children knows that you're in the labor delivery and they're doing the ultrasound, and it's just the nurse that's there on the unit. There's no special training required for the basic ultrasound. It's put the gel on and run the wand over, and you can see what you need to see. And so consequently, again, we're seeing it happen in clinics, in L&D, in other areas than in radiology. And so the matching up of the revenues and expenses in these types of services are becoming more difficult. So how do you think through these issues? How do you identify what to do and how to treat them? And the first question I always ask is there a way to segregate the expenses? Is there a way? Is there an ultrasound tech that lives on the L&D unit? And if not, okay, that's a nursing staff. How do I parse out the nursing staff? It's kind of commingled. It's harder to do. But you might find that there might be a lab tech that lives in the clinic. And so they're probably doing a lot of the lab tests and things. So you need to ask these kinds of questions and look at, is there a way to segregate and identify the expenses associated with the issue? The second thing is there a way to, now that I know what the expense is there a way to identify the total revenue provided for that service for all of the patients, and does it match where my expenses are? And so you need to look at both the expense and the revenue side independently, and then bring them together on a work paper and say, okay, do they match up? How close is it? Do I need to do any adjustments? And that's where you're going to find your reclasses and both expense and revenue reclasses that are going to impact your cost report. How do I think through the issues? Again, we talked about do I have separately identifiable expense and revenues? If the expenses are not separately identifiable, is the cost per treatment the same for all the different locations? Usually the answer is no, because the staff at a clinic are being paid significantly different than the staff in the ER versus the staff in L&D and the other. So usually the answer is they're not, if they're commingled, they're not being expensed the same way. And so if you can't segregate the expenses, and therefore you're stuck with, the revenues, but you really don't know the expense, there is another way that you can look at this issue. And that is, you can, instead of spreading or reclassing the expenses, you can leave the expenses where they are, make sure that the revenues for those revenue codes are in the same departments. Even though the cost is commingled, you leave it in the departments, but then on your settlement, you take your Medicare charges and you spread for that revenue code, for ultrasound, for EKG, for lab, you spread that revenue code based on where the revenue showed up for that same revenue code in your revenue and usage file. So you're basically saying, I cannot segregate the expenses. The average cost to charge ratio for that department will drive my cost of calculation, and you're then going to spread the Medicare revenue to that associated department, and it will pick up its fair share of that cost. So those are the two ways that I look at it. And again, I use analysis and I look at, can I directly identify the expense and the revenue? And if the expense is not directly identifiable, can I calculate it? Is it the same cost per treatment? And if not, then I'm probably going to spread. So 3 different treatment types. So again, talking about this same issue, I have a work paper that I put in Worksheet C that was an analysis of new revenue. And this is the 3 issues that we just talked about: lab, EKG, and ultrasound. Now, one thing to note, this is 2017 data. So this was when this issue was really starting to blossom, but you can see it here. Laboratory, you can see most of the lab dollars are in the lab. The revenue is right where it belongs, or where you would expect it to be. But then you're starting to see revenue related to the lab in cardiopulmonology, you're seeing it in the clinics. And those are the beginnings of those point of care tests. When you look at the revenue codes, it's generally the generic revenue code of 300 versus the revenue codes 301 through 309, which are a little more specific to pathology and things like that. And those are the ones that are your primary lab up here, the big dollars. But you do need to recognize that revenue code 300 is showing up in other departments. The same thing is true with EKG. Here's the main EKG, $22 million overall in the respiratory therapy line. Makes perfect sense. But then you can see in the clinics, we have almost $800,000 of revenue for EKGs. And those are those basic EKGs that are being done by the staff, not a respiratory therapy or a EKG tech. And we're starting to see that in more and more places. When we talk about ultrasound, the radiology department is exactly where we expect most of that revenue to be. But then what you see is, here it is in the women's unit, the labor and delivery unit. Here it is again in the this particular provider has 3 labor delivery units that are all commingled. But you also see it down here in IV services, because when they're doing, it's for a cancer center, I believe, and when they do the IVs, sometimes they need an ultrasound to make sure they get it in the vein. And so again, it's not an ultrasound tech. It happens to be just a nurse that can do it. They do the ultrasound, they slide the needle in, and they let it go. But it's still a billable procedure. So these are the kinds of things that I'm talking about. And this type of analysis is what I would use. I look at revenue by revenue code for certain issues and start grouping it by department and say, where is it actually landing? Where am I seeing revenue that I normally would think lab should all be in lab is actually hitting in other places, and start asking the question, why is it there? Are we doing tests, and are they lab people that are doing the tests? And if they're lab people doing the tests, then the revenue has to move. If it's not lab people, then we have to decide, do we reclass expense and revenue, or do we spread the revenue on Medicare based on the location of the expense? So those are the kinds of analysis that you're going to want to look at. Let's see if anybody has any questions at this point. I do have one here. When I was discussing the wage index analysis, I did a calculation of average hourly rate by earnings code, correct. How often do I need to do this analysis? And are there any additional considerations? Well, it's really 2 questions, but I'll answer them both. The first part of the question is how often? I generally do it once every 3 years at a minimum. And the reason for that is because of the occupational mix, which uses the same information in a lot of the same ways, where we need to know that our includable versus excludable hours are correct. So at a minimum, I redo the analysis that you saw in my Excel spreadsheet where I said every earning code and the average hourly rate. I redo that analysis every 3 years just to make sure that something hasn't changed. But also, if your payroll system is going through any kind of upgrades, or especially if it's going through a conversion, you definitely will want to do that analysis every year for a couple of years as the new system or the upgrades settle down, because you'll see changes over a time period for that. Are there any additional considerations with that? I would say that the biggest consideration is the cost report lines, because that's going to tell you where that hours goes on the cost report for wage index or for the occupational mix, or the type of employee, which would be the job code. But that's going one step further than what we were talking about. We were talking about including versus excluding hours. And so there's nothing other than the earnings codes, some people call them pay codes, that I would focus on. But going forward with your cost report, when you start looking at actually putting dollars on S3 Part 2 for the actual wage index, it's actually grouped by cost report line. So you want to make sure that your groupings are correct. Are there departments that are in your payroll that are not in your general ledger? And start asking questions about those as well to make sure that you know how to handle them. Don't just assume that they're all admin. There are a lot of times when payroll will break out a department specifically for some administrative purpose, but you need to know what department that actually related to. I have a second question here. When confronted by a service that we think is not matching revenue and expense, I gave you 2 or 3 options, okay? Is there a proper order to these to determine what's the best course of action? Okay, that's a good question. Yeah, the order that I usually go in is, if the expense is distinctly identifiable, I use an A6 reclass. I move the dollars and I make sure that the revenues are reclassed with it. And that's my first choice. I want them to be identifiable. When it's not identifiable, I take a really hard look at whether I'm going to calculate or impute the amount of cost I really need to take a look at, is the cost per treatment about the same at all the locations? That's really critical. And that's a judgment call, but if I feel that there is a significant enough variance, I won't do a reclass. If they're pretty much the same cost, I would go ahead and, again, reclass the expense. I've calculated it out, reclass the expense, and reclass the revenue. But then the last choice is when I can't directly identify and I cannot say that the average cost per is the same. That's when I leave it with the original. It stays where it was originally booked because it's commingled expense. I make sure the revenue is in the same department, and then I use the settlement section to allocate the revenue. Okay, I think that's all the questions that we had so far. If you folks have any other questions, please feel free to send them to me or to us. You can always email us at easyworkpapers@besler.com. And hopefully you found this valuable and insightful. And we will see you back for our next installment as soon as we put it together.
That concludes today's webinar presentation. Thank you for attending and have a great day.